Okay, good afternoon, good morning, good evening, everybody. This is Nick Aalerud and Axel Ragnarrson. We are the co-sponsors and general partners of a new acquisition that's coming up in Manchester, New Hampshire. We're going to be talking a lot about today. If you're seeing this message, that means that you have a substantive relationship with either Brickleaf Properties or AA Real Estate Group or myself or with Axel. If you do not have, if you're seeing this in error, please make sure that you discard this and just let us know. We'll make sure we kick you off our lists. If you are interested in getting to know us, we're happy to obviously talk to you and share about what we do. But for today, we're going to go through who we are. We're going to go a little bit over the overview of the project, overview of the area, and look forward to hopefully answering most of your questions on this webinar. And if at the end of this webinar you do not have your questions answered, by all means, shoot them over to us and we are happy to take care of you. So Axel, I'm going to kick it to you for the beginning.
All right, sounds good. So I think Nick really already mentioned it, but we'll start with our background, our credibility, who we are, and I'll give the spark notes on me. So basically started investing in Manchester, New Hampshire about 5 years ago. Have since built a portfolio there of about 100 doors, owned some more units up there with some partners, and also co-founded a property management company with my partner, Ryan Weiss, who is not on this call, but his bio is listed here in an overview. And basically, we've identified Manchester as a market that has a significant amount of mom and pop sellers, and there's a lot of investing in that market in terms of older folks that have been investing for years that haven't really caught up with the market. And we found that there is just loads of opportunity in terms of finding underutilized smaller multifamily projects up there, and that's kind of the niche that we've carved out for ourselves, is doing small to mid-sized multifamily projects where we've been buying them directly from owners. So outside of that, I have some background in going out of state and actually raising some capital for some mid to larger deals. I'll go ahead and jump into some more deals that I've personally done. And just for context, this is a overview that I've put together. So these deals are my background specifically, and I'm sure Nick is going to jump into obviously all the fun stuff he's been up to. But here are just some highlights in terms of past deals that we've actually exited and actually delivered LP capital back. In terms of we've taken it full cycle and at least gotten to a capital event and delivered good chunks of LP capital back. So you'll notice a couple of deals in here down in Lakeland, Florida. Those are deals that we actually closed beginning of 2021, and we've already hit our refi and delivered 75%, if not 100%, depending on the deal, of all the limited partner capital back on those. Did the same thing with a 24-unit multifamily portfolio that's almost an exact replica of this deal, just on a slightly smaller size. And that's a deal that we did. Closed on it late 2020, delivered all LP capital back in mid 2021, early summer of this year, and involved in some other projects as well. So GP and a 104-unit deal down in Houston with some partners, GP and a 204-unit deal out in Phoenix with some partners, closing on a couple of deals here that I've listed, 23 down in Minneapolis, and obviously the deal that we're talking about today, 40-unit portfolio on the west side of Manchester. So in terms of the profile of this deal, certainly something that I personally have experience with, and something that our management company has experience with, in terms of taking a project from close with underutilized attributes to it, in terms of low rents, not fulfilling the highest and best use of what the property is, and actually getting it to its highest and best use. So that's kind of the high level backstory. And I guess because people like to hear numbers, $27 million worth of transactions or so. Couple hundred doors in the portfolio, most of which I have a bulk of the equity in, and been doing it full time for 4 or 5 years. So those are the high level ones, and hopefully some of these past deals illustrate a lot of what we do. So I'll kick it back to you, Nick. Hopefully that was good.
Yeah, and honestly, that's why I think that this partnership makes an awful lot of sense. For those of you seeing this video, a lot of you probably already know of me, which is why we're sending it out to you. But my name is Nick Aalerud. I'm the founder of AA Real Estate Group. I've been a real estate investor full-time since 2008, and I've been in the game since 2005. So we've been in this for 16 years. We have completed, on the single family side, about 350 projects all through between Greater Boston and Manchester, New Hampshire. And in 2009, we started our rental portfolio. We started it out of state We had a few in like the Haverhill, Lowell area. Then we opened up a market out in Western Pennsylvania and in Ohio and in Florida. So 2010 and 11, we had some experience in doing some syndication work like Axel with being a general partner on some bigger deals down in the Carolinas, as well as in Texas. And with my share of a lot of you know me because I like to be very open and share my challenges in real estate. Because of some of the challenges we made, we've also kind of been super hyper focused on how to mitigate challenges that I personally have gone through so that no one that I know has to go through those challenges. And one of those was coming up with a world-class property management firm. And knowing that, I also know Axel's passion has been the same. So roughly kind of aligning in the same boat, and also having independently, we both identified Manchester, New Hampshire. We've since liquidated a lot of our holdings in the Massachusetts market in favor of this Southern New Hampshire market, because we feel like this is definitely a path of progress. And it's also, we're seeing a rebirth and what's the word there? I guess gentrification of this mill city. Which is also where I went to school. I went to college in San Anselmo College, and that's the background here. With my credibility, I have more so on the single family side, but we just similar to Axel, we completed a 20 unit, completely turned 20 units in Ohio, where we purchased it and then exited before we even finished the capital expenditures on the third building. We actually did end up turning that because we had another local operator that saw what we were doing and was like, "That's exciting," and we exited that one. We've had a few exits. We had a 222 unit building in Lexington, Kentucky that I was involved with. That was also a full turn. So we both have identified Manchester as a solid market opportunity. And it just made sense, seeing that we were both doing the same things and we had similar interests and similar targets and goals, especially with his feet on the ground and my feet on the ground up in this particular market. I'm excited to partner with him on this. And I think we both bring a lot of value to the table. So that's my background for the most part. And for anybody who wants to hear about my challenges, I'm happy to chat about that in another webinar, or you've already seen a podcast, or you've already seen me speak in one of the groups locally. So anyway, we'll keep moving on.
All right. So I think what we're going to do now is Nick is going to run through the deal here, how it was found, kind of the high level overview, seller profile, business plan. He can tap me in as needed, but I'll kick it back over to you here, Nick.
Sure. Yep, absolutely. So this deal, my team sourced this deal. It was an off-market opportunity. That's typically all we do. This was a seller that had gone through a divorce. I believe Axel also spoke to the seller a few years back, which is another reason why I'm happy to work with him on this. But she was going through a divorce, received all these assets in a divorce, and does not want to deal with them anymore. She did, after we got involved, did hire the help of a local broker to assist her in the negotiations. But we've gotten a fairly decent discount from where we started. We've been working this deal for about 18 months. It originally started at a $4.8 million ask, and we're down to a $4.2 million purchase price for 40 units across 7 buildings in Manchester, New Hampshire. The big play here is that most of the units have been managed. I'm not going to say poorly managed, but I am going to say poorly managed, because that's essentially what they have been. They're at low rents that have not been updated in at least 7 to 8 years. Some of them are much more long-term tenants. And they all need a little bit of love. Some need a lot of love as far as capital expenditures go. So the same basic value add plan that Axel and I both have experience with is our plan is to take down the portfolio with a short-term bridge loan, which is a 24-month loan from a lender that also can involve a construction element and can also help us be flexible and aggressive in what they are able to offer. We go through building by building and unit by unit and update the vacant ones. And at that point, we also start to work with the existing clientele to see who is able to qualify to move into our renovated units. And we slowly move them in one by one. Hopefully they can qualify. And if they can't qualify, we also have a member of our team that tries to help relocate them into other housing. So we're not just the people that just kick people out either. We try to work with people and at that point. And once we do have the units rehabbed, we have them released up at our market rates, which you'll see in a bit. At that point, we then go for a permanent financing, which in this case would be an agency debt partner, be it a Fannie, Freddie, or FHA debt partner. We already have a lender that has worked with us in the past, and that should get us into much more favorable financing. And our play here is that the investors will hopefully get their capital back in year 2. Again, we'll go over this in the financial spreadsheet later. And everyone still maintains their 50% ownership in the deal even after they get their capital back, which is something that we don't usually do, but we're able to do that on some deals. And this is one of the deals that Axel and I both said, I think it's local. A lot of people like the local aspect and element of this deal, and the numbers still work. So let's work through it. But that's the anticipated timeline. So we have year 1. There's going to be significant negative cash flow, which is why we're also building in a reserve contingency in our equity raise. And that's when our vacancy shoots up. We have a bunch of evictions, most likely. A lot of people like to stop paying rent when they know ownership is changing. Just happens. And then we start to go through the buildings and the units one by one. And then in year 2, we're estimating at month 18, possibly earlier, but we'd like to say month 18, that we're going to have these stabilized. And then we're going to go for our permanent financing, which should get the investors their capital back by the end of year 2. So I said that twice now, but I think, did I cover the overview? I think I did, right?
I'll hop in and just add two quick comments as it relates to what people are looking at on their screen here, which is this kind of summary. And just for context too, those who are seeing this that know me probably associate me with Brickleaf Properties. Literally last week, we just underwent a rebrand to, Aligned Real Estate Partners, which is why you're seeing different branding here, but don't want to confuse anyone on that front. But also, you'll see in the timeline here, and as well as these projections, they're going to differ a little bit slightly from both what Nick just mentioned and what we see on the actual underwriting when we hop into that. And that's because originally we were hoping to refi this in a year. But I think that what makes the most sense return wise and just business plan wise is to kick this refi out until the end of year 2. So that's going to be responsible for some of the changes you see in annual return, cash on cash, as well as the fact that we've underwritten agency or basically agency debt as our refi. So we think we're going to be able to get 12 months interest only on that refinance, which is pretty standard in this market. These projections weren't underwritten with a year of interest only on the refinance, which is why you'll see a slightly lower cash on cash return in this executive summary than when we hop over into the underwriting. So fundamentally all good news, but just explaining that difference for when we get into that. So wanted to touch on that piece.
Perfect. Yep. We are offering, so in this particular sheet, and you will see all the specifics, we are offering in this particular offering, we're doing a 9% preferred return. What that means is all investors, no general partners and no sponsors will actually be getting paid until we hit that hurdle of a 9% return to any principal that is still in the deal. So that is assigned to the 50% of the limited partners that are in the deal with their capital. So that is that 9%. That is what that means. And that's kind of your base return. And above that 9%, once the principal is returned to you, which again, we anticipate at least 90% to be returned, if not 100% on year 2, that 9% goes away, but you get all your money back and you're still a 50% partner in the cash flow and in the equity of this asset, which is it's a really cool, neat feature that we're happy to go through when we get to the financials.
Exactly. And probably the segue into the financials is quickly touching on this. So again, these were underwritten before we actually really dialed in our projections. This was refining after year 1, no interest only on our agency debt, on our takeout refinance. But these are basically even more conservative returns than what we're actually seeing on the actual underwriting. So this target scenario of an 8.5% cash on cash return is we found that's going to be pretty light given what our actual the brokers that we've talked to and discussed what agency debt would look like for this on a refinance is actually going to look a lot better than this in terms of the numbers. However, this is a great illustration of the true downside scenario for the deal. And this is really kind of the worst case scenario with really high expense ratios, low rents, CapEx budget of, much higher than what we know it's going to take to turn these units over. and, still very competitive average annual returns in comparison to what the market's offering nowadays. And what we're finding in reality, given the numbers that we have in this market, really what are still pretty projected or are pretty conservative projected rents, given what we're seeing, is what you're going to see here on the right in terms of investor performance. 8.5% cash on cash, about touching a 20% average annual return. And this is what we found is actually pretty representative of the deal, with a better cash on cash, given that we're going to be getting some interest only when we refinance. So wanted to touch on that before we get into the fun Excel sheet and start talking about our assumptions and actually show people what's behind the hood. But I guess, Nick, if you want to add anything to that, feel free before we get into that piece.
Yeah, no, I mean, they'll see the legitimate new underwriting returns that we have here on the sheet. This was pretty much the sexy credibility kit that everybody usually wants to see, and here you have it. So, Axel, I appreciate you putting that together.
Great.
All right, I will switch over to the other sheet
go ahead
now.
And stop sharing my screen. Yep.
All right, perfect. So this is the boring and the exciting stuff, depending on who you are and your personality type. I came from the banking background. For those of you who don't know me, this is what I totally missed at the beginning of the presentation. I started in mutual funds, banks, and mutual funds, bonds, and stocks at Mellon Bank, which is now Bank of New York Mellon in the Boston area. So I'm a huge Excel nerd. I'm a huge stats nerd, and I'm also a huge market nerd. So that's why I love to identify what I consider emerging markets, what I consider path of progress, what I consider growth markets. And we'll go through the overview here. So you just saw the original projections. Right now, we are purchasing this asset for $4.2 million in negotiations with the seller. So we were able to get a full underwriting package on this one. That's not typically normal when we're buying these value-add portfolios. Value-add portfolios are typically sellers, like Axel mentioned, mom and pop owners that might be self-managing or have a management company that isn't really doesn't have the technology, doesn't have the processes and systems behind them. So typically, a lot of times they don't have full leases, full tax returns, full P&Ls, and full bank account. Like we were able to get a full financial package from this seller, which was fantastic, because we were then able to verify, existing rents, existing expenses, existing incomes, knowing that we were going to be putting everything into place for what we know as projected revenue, what we know for our projected expenses, what we know for our projected vacancies. And we then, using both of those numbers, we were then able to negotiate the deal. So in this particular deal, we're paying $4.2 million, which is roughly $105,000 per door. We are getting a loan on this for 89% loan to cost. That's with our bridge lender there. So they're coming in with about 3.7, but they're also adding in the $300,000 reserve budget, which is there to pay down the mortgage essentially for the first 9 or 10 months of the deal, which is it's actually a blessing for us, right? The less cash we have to outlay at the beginning while we're doing the capital intensive rehab and the construction, the better. So we have a negative on our closing costs here. Now, this is because in our physical inspections, when we did our walkthroughs, Axel and his team also did them. We took a lot of photos and we determined that the CapEx required to fix these units was less than what the seller said that they needed, which, by the way, is completely normal, and we're pretty much used to that at this point. So seller said things were recently renovated within the past 5 years, and that's part why we do due diligence, right? So the team went out, identified our construction at roughly about $400,000. We had originally budgeted about $250,000 or a little less than that for the construction. So the seller was giving us $175,000 back, which we're taking at the closing, which is why our closing costs are negative. We have our deposits, which are already in. We have a reserve of about $150,000 in addition to the lender, $300,000 that we're going to be raising here, which means our all-in project amount is roughly just over $4.7 million. Our total equity raise then comes to just under $1 million at about $980,000. We do believe that's an overraise. It's probably an overraise by about $150,000, but we want to make sure that we do have. We want to make sure we're very liquid going into this. We want to make sure that everybody's safe and that there are no issues that we can foresee on the board when we get into the construction element. That said, the actual, I think we're going to get into, well, right now, so here are the actual numbers before we jump into the maps. We're going to talk to you about our plan here on the rents in a second and where the rents are. Actually, you know what? Let's do that right now. Actuals and unit mix is where we're at here. So right now, here's where we're at. These were the actual numbers that we were gathered from the seller. With 40 units, there's an average monthly rent between all the one-bedroom units. Here's the unit mix, right? There's one office space. There's 25 one-bedroom units, 11 two-bedroom units, and 3 2 and 1.5, 2 beds, 1.5 bath units. And these are the current rents. They're extremely, extremely low. Axel's going to get into exactly what we have currently. He and I both have independent portfolios already in Manchester with proven rents and proven expenses on the units, which also makes this kind of a no-brainer deal for us, for he and I. So that said, Axel, we'll get into the sexy map, and you take us for a tour of Manchester, will you?
Sounds good. All right, so I'll go ahead and take the screen back here. All right, so basically, I want to start with a quick overview of Manchester, just from a top-down perspective. So for those who aren't familiar with Manchester, it's really split into two parts, east side and west side of Manchester, with the Merrimack River kind of dividing the city in half here. What I'm going to zoom into is what's considered to be the worst part of Manchester. That's not where these properties are located. This is, where people hear Manchester and they think negative things. It's not entirely true for the whole city, first of all, but this is where a lot of that stuff is going down. So you have Elm Street right here, which is really the key street in Manchester. And this whole block, and I could, I wish I could highlight this, but basically, if you can follow my cursor, this general area here is really where a lot of the this is where a lot of the crime is. This is really, a C- class area in terms of the tenant quality, in terms of the types of actual assets that are here. It's a lot of, deferred maintenance, kind of beat up buildings. And this is really where you want to be careful when you're investing in Manchester. Lake Ave, Spruce Street, you have Union Street here, Lincoln Street. Basically, if I'm going to zoom back out, it's central, people call this central or east central Manchester, and that's the tougher part of Manchester. And I bring that up because I'm going to use that for rent comparables when we start talking about rent comparables. Now, if I head over to
while you're chatting, Axel, there's a lot of investors like you and I that are looking to turn that entire area around, like new builds on Hanover Street, just for the record. So don't bash it too much.
I know, I'm just accurately setting the stage, I think. Yeah, but there
Yes.
is a lot of dollars going in here and a lot of sophisticated investors coming in here and helping to turn this area around. I mean, I like to think I'm one of them. Nick, you're certainly one of them. But if we head over to the west side, in general, top-down view of the west side, if you're thinking about the nice areas on the west side, most investors categorize that as the northern part of the west side, so kind of northwest Manchester. Kelly Street is highlighted as kind of the main street that divides, the midwest side and the upper west side. So anything that's north of Kelly Street is considered to be some of the nicest parts of Manchester in terms of multifamily property. There are a lot of single families up here, a lot of owner occupied 3 units, duplexes. This is where you're going to find the best tenant base for what's considered to be, more urban Manchester. So if you jump in here a little bit closer, and we even, further narrow it down, Kelly Street again being here, even slightly south of Kelly Street, heading down, to kind of basically Granite Street's what truly divides the west side of Manchester in half. Even if you head just slightly south of Kelly Street, all of this is really where you want to be if you're investing in Manchester. These are great neighborhoods, B neighborhoods. And really what anchors that in a lot of ways is CMC here, Catholic Medical Center. There's a lot of high paying jobs in this area, a lot of traveling nurses, a lot of medical professionals. There's a lot of folks that live here that work in central Manchester and actually work in, kind of the more core business district of Manchester. And basically the takeaway from what I'm discussing here is upper west side of Manchester is really where you want to be. Now, as it relates to the properties in our specific portfolio, I'm just going to use a couple as an example. And these properties are in the executive summary in the PDF that I was just in as we were talking about our backgrounds. It actually outlines all of the addresses. But I want to jump in here, and without getting too in the weeds, I'm going to try and describe, our rent projections in comparison to what we're seeing in the market. So for example, 200 Reed Street is one of the buildings in this portfolio. That's a 5-unit building. Reed Street is actually mainly single family homes. You have some duplexes here, but they're nicer duplexes that are typically owner occupied. All of these bordering streets are typically single family homes. There's not a lot of large apartment buildings, a lot of, nicely taken care of lawns. This is just a street that you want to be. For example, with this property, we're projecting $1,200 a unit. They're all 1-bedroom units. And in comparison with what's going on throughout the rest of Manchester, there's a couple of good comps here that we own and that we manage. So, and I say we manage, our property management company manages. So for example, if you follow my cursor here on Amory Street, now we're heading south. We're south of Kelly Street, as that was kind of the street that I was talking about as one of the nicer divides here. Amory Street, we manage a couple of 6-unit buildings on this street. And we're getting $1,200 to $1,225 for all of our 1-bedroom units. And the buildings themselves are in worse condition, ugly yellow asbestos siding comparatively to 200 Reed Street, which you can kind of catch a glimpse on the Google image here. This sidewalk has been cleaned up. It doesn't look like that anymore, but as a comparison point, I think it's a great comp in terms of what we're renting these for. So 239 Amory Street is one of the buildings in the portfolio that's also right here on Amory Street. We're projecting, for example, $1,600 for a lot of those 3-bedroom units. And, we have 2-bedroom units in this Amory Street building that we're getting $1,450, $1,500 for. So we're really right in line with what we're seeing in the market, like as of today. And, if I want to continue discussing a lot of what we're doing here in the West Side, a building that we actually just sold and got out of, but is a great comparable for a lot of the units in this portfolio. Go ahead and just type it in, 96 Notre Dame Ave. And you see now we're heading south. And if I back up just a little bit for context, we're significantly farther south of Kelly Street. We're getting farther south. And as you head farther south down into kind of south of Granite Street in this area, that's kind of a less desirable part of the West Side. For context, we had a very standard size 1-bedroom unit in here that we renovated, and we leased it at $1,175, and we were absolutely inundated with applications. We under rented that unit completely. We could have rented it for higher. That is a less desirable area, just plain and simple, as most of the buildings in this portfolio. And we also manage numerous other buildings in this area as well. So we manage some properties on Sullivan Street here, on Putnam Street, and we're consistently getting $1,150 to $1,250 for our 1-beds, and $1,450 to even higher than $1,500 on some of our 2-beds, depending on size. And for context, we are projecting $1,200 across the board for 1-beds, and $1,400 for our 2-beds. Excuse me. So just to show you where some of the other properties are in this portfolio, because I think it's important. We have one building on 588 Montgomery, again north of Kelly Street. We have a property. Trying to get 601 Heavey Street in here. Again, that's north of Kelly. I'm not going to do it for every property, but the point I'm trying to make is this portfolio is extremely well situated on the west side of Manchester. And within the context of Manchester, this is where you want to be. We manage numerous units in this neighborhood, and we have direct kind of proven market feedback on our rents. So it's not, we're not coming into a market that we don't know and trying to figure out what the rents are. We have, direct feedback from the market on our projections. And we think they're conservative as a result, because, we're leasing properties in less desirable areas, same unit size, for these projected rents. And as we accept applications, we're basically telling ourselves, we could have gotten another $25-50 just based on the feedback from the market. So I could spend all day talking about this, and I'll touch on a couple of stuff here on the west side. For example, here's a good comp. 17 South Street is a property that I personally own. This is not where you want to be in Manchester. I'll just tell you that right now. I've owned this for a while. It's one of the properties that I'll probably sell sooner than later. It's not a bad area of Manchester, though, by any means, in terms of comparatively to, if you head farther south, where I was talking about 5 minutes ago. But basically, this is, black and white, a less desirable neighborhood than what we're talking about on the west side. And we're getting $1,375 for our 2-bedroom units that are the same size, no off-street parking. We have off-street parking in all the properties within this portfolio. No off-street parking, no yard, no privacy. just, black and white, less desirable neighborhood. And, so we have a lot of direct comparables, even in worse neighborhoods too, that are right around our projected rents. So, basically the long story short is rents make these deals. We're really confident in the rents. And in terms of where these properties are in the Manchester, this is kind of where you want to be, is the cream of the crop for urban Manchester. So I'll stop talking. I think that's probably a good enough overview, and I can kick it back to you here, Nick, if you want to
If
jump into
you
it.
go to Amory Street again, Axel, if you just zoom in there.
Yep. So Amory
So,
Street is right here.
Yeah. So one thing that people should know about you and I is that literally, like, you and I we're trying to make all the numbers in spreadsheet worse before we get on the webinar, right? Like, how can we change the spreadsheet to make these returns worse and to actually try to build this deal in? We run a 6-family also on Amory Street, separate from Axel's property management company. As we mentioned, it made sense for Axel and we are a partner, since we both have similar interests and we both have a vertically integrated company, right? Construction companies, property management company, brokerage company. We have it all covered. 374 Amory Street is something that we had just renovated. And that particular, there you go. You can zoom in there. I don't know if that's there it is, under construction in the Google photo. Yeah. That particular 6-unit building, they're all 2-bedroom units. They're all 650 square feet. And just for comparison's sake, we decided to do a test. So our 2 bedrooms that are completely renovated are, market rate was between $1,650 and $1,800 for each one. We have them rented at $1,800 right now. And we also tested, this is not our business model, right? But we tested the short-term model, a short-term rental model with nurses and doctors, specifically with Catholic Medical Center. That has turned out to be a success. So we now have 3 of our units designated solely for short-term rentals, and they are getting $2,000 a month for that rent. So again, that's not part of our business model, but this specific area of Manchester, as Axel shared, this Upper West Side, being nearby the CMC, the Catholic Medical Center, that's another play that makes what I feel our rents are very conservative, which I'm going to show you right now. So I'm going to go back into the sheet here.
Gonna stop sharing.
There we go. Okay. So I'm going to go into this, here's the actual. So we talked about it. We are anticipating about 1,200, you said, right, Axel, for the 1 bedrooms?
Yeah, so we even did our underwriting more conservatively at 1,175 in this model, but 1,200 is slam dunk for all these units that are 1 beds.
Agreed. And we have 1,400 for the 2 beds. Again, we're getting 1,600 for our renovated 2 bedrooms. We're getting 1,800 and 2,000 for our 2-bedroom units. I know between the two of us, so Axel and I wanted to be very conservative with these. And I'm going to show you the P&L now, which is roughly our plan by year. So in this particular case, right, we have our actuals down here. These are the numbers that came direct from the seller, and my team spent, a solid 45 days reviewing financials, going through everything, making sure things were where they were supposed to be. And we also then attributed our own projections onto these items. So obviously the first year, this is our cash intensive year. We're going to be going through, as we mentioned, the vacant units and renovating them with all of our CapEx budgets that we have. We're going to be doing some new systems. We're going to be doing kitchens and baths for sure. We're going to be doing some flooring work, a lot of paint. We're making them up to both of our standards. Those standards are what we do to get our higher rents that we are projecting. So there, we've estimated a rough 20% vacancy in year 1, with another 2% and people just stopping paying. And we upped our taxes considerably. For those of you who know, and we also ran a stress test as well. If we ran it to like $75,000, so we know the taxes will be going up. We were trying to be conservative in these numbers, and you'll see that we still have a huge buffer regardless. So we also have an insurance, a buffer in here in insurance. We have there's still a lot of units that are paying gas. They have those old school gas stoves, so we're paying a lot of the gas here. We did have one management strategy where we implement RUBS, which is a ratio utility billing system on certain utilities, in this case, water, sewer. We've successfully implemented this on our units in Manchester, and we're looking to try to do that again. And you can see that saves a significant amount of capital. It basically puts the onus on the unit owners by individuals to pay their water bills, which also coincidentally makes the water bills go down substantially because people are now responsible for their own water, sewer. We have the management fee in here, which is going to Brickleaf, or is it Brickleaf still for the management, or Axel?
Blue Door Living is the name of our management
Oh, Blue Door Living, that's right. So they're managing that at as low a discount as we possibly can for all our own portfolio. I personally also know that property management companies really aren't there to make money. They're there to help serve acquisitions, to help serve investors. So I understand where that is. We have some repairs and maintenance. Now, this is not high because remember, we're putting in $400,000 up front into these units. So after putting that money in, we anticipate the repairs and maintenance to still be around that 20,000 mark. And as this goes, you can see our we're going to come down here to our gross cash flow available for distribution. So, negative 150,000 first year. And then the second year where our rents are still going up, right? So now year 2 is where we're finishing up our post stabilization, or our capital expenditures are all finishing up, and we're finally leasing up all the units. So our rents are still at a very high rental rate here. We're now at an average of about 1,300 for the rents with normal vacancy rates for this area. We're running right now we have a 0% vacancy right now in Manchester, but we always run at a 5%. So we're running at 6% here in the projections. And all of our expense, we have our expense raise in here, and we have our income raise in here. You can see at the top. Going forward after this, we have one more raise of about 2.5% in our rents. And then we have our expense increase of our 2%. So beyond that, we just keep it at 2% raises going forward for both income and expenses. Down here, you'll see what that does to the capital. So the first year is obviously highly negative, right? We don't anticipate any cash return in year 1 while we go through the heavy rehab on these units, while we go through all the evictions, while we go through the lease ups of the units. And year 2, same, we're probably not going to see any cash distributed until the refinance, which we anticipate will be around month 18. But we encourage you to think at the end of the second year, right? So think 24 months. If we deliver in 18, if we deliver in 14, even better. But think 24 months on your plate there. And then finally, at this year, the LPs will receive. The goal is for them to receive all or most of their capital back. There's going to be a few investors that have already alerted us that if we don't get the capital back, they want to keep their cash in the deal and still have their 9% running. At that point, we will be paying them out in year 3, year 4, or year 5 with GP cash flow that comes back. But starting in year 3, after the agency debt has been placed and we now have more favorable long-term debt in play, we now have everything stabilized to a point where we have our young professional tenants and at the rates we want, with the expenses controlled, with freshly rehabbed units. We're now looking at a cash flowing. Oops, those are distributions, or projected distributions. I wanted to look at the net operating income. Net operating income is how you determine the value of an asset. I won't go too far into that in this webinar. Most of you on here already know about that, but in order to assess the value of the unit and what the agency debt will be doing, is they're going to be taking this number. This is year 2 number, by the way, at around 391, and they're going to be assigning the local cap rate to it, which we have identified at about 6.5%. Let's see if that's in here. Yep, we have 6.5% cap rate at refi, which roughly then returns. Let's see where we are here. Can't see because I have a Zoom box in the way here. Which roughly then returns. This is by the share. Oh, I can't go up. Where's Class A here? Where's the whole thing?
No, that's what you're looking for right there. Is if you head up, you have return of member capital as if it's, as we're talking about LPs here.
Got it. Okay, so Class B. So we have about 979 in with member capital. Well, I don't even know if we've mentioned this too. Axel and I we have our own cash in this deal as well. So we're also on the capital stack with you. A lot of times sponsors don't have any capital involved in the deals. In this case, we absolutely do. So ultimately, year 2, which is our refi year, project cash flow is still negative, right? Because we're still spending that whole year trying to make sure leases get leased up with the higher rents, and return of member capital from that 979 we're looking at around 655,000 to be returned, which means that there's going to be 324 left in the deal. That's going to be distributed. That's going to be kept in the deal based on the people we're going to speak to. If you want to be one of those longer term investors, you can just let us know. The 9% pref does run on this capital that's left in the deal. So as long as that's left in the deal, the general partners will be paying that off annually with some cash flow, but you still get your 9% on this if you do leave it in the deal with us. So that is the rough plan for year 1 and year 2. This whole model has a resale at year 5. That's not our intent on this, right, Axel? I mean, we're looking to hopefully hold on to this long term as our portfolio hold. If the market does shift, we do have the ability to obviously reassess every single year, right? Like we also anticipated on holding our Massachusetts portfolio forever until the market did what it did and it became just completely stupid, and we sold at ridiculous returns to everybody because the market here in Boston became stupid. So that's at least my play on it. And I think, did I go over most of the story on this? I think I did, right?
Yeah, I think that's everything.
So here's our refi exit.
You can touch on CapEx and reserves as well, maybe in terms of the per unit renovation cost that we're looking at.
Yeah, we'll do that here. So we have a rough, for interior renovations, this is a very rough budget that we established. This is also before we, it was after we walked through the units. We're getting a specific unit by unit, right? Each unit is going to be a little bit different, but that's why we have this $400,000 budgeted. And 340,000 is what we have for interior renovations. Now, a lot of them, actually, you saw these units physically. We have them in photo form. A lot of it's kitchens, right? It's baths. We have flooring. We have paint. We have some heating systems to be redone, but the exteriors were in pretty good shape. Was that accurate?
Yeah, so the high level story is exteriors are all good in terms of exterior decks, porches, siding, and roofs. Those are all pretty solid. As for the actual units themselves, pretty much every unit, if we're turning it over, we're going to be doing paint and flooring. A smaller percentage of the units, we're going to be going out there and actually, replacing cabinets in the kitchens. I mean, a lot of the cabinets we can save and we'll just end up painting them. So it's not guaranteed that on every single unit we're going to be replacing, vanities and tub surrounds and actual kitchen cabinets and counters. That's probably 50% of the units, just off the top of my head. But what's nice here is that, some of these units are going to be lighter turnover. Some of them are going to be more moderate. An average of $8,000 a unit is kind of in line with what the average would be across the whole portfolio. But the good thing is that all of our CapEx dollars are going to be spent on really value add CapEx items. So, we're not spending items or spending money on, for example, big ticket items like siding, roofs, or decks, which aren't helping to increase rents. All of those items have been taken care of. So every dollar we're spending has a, direct translation to the NOI.
Indeed. Excellent. We also have, for what it's worth, internally, we have a 44-point value add checklist. We offer this to landlords at $10,000 to go through their properties. Obviously, if, we manage with their units, it's one of those things that we do as a value add for our clients, being that Axel and I are running this project, right, that we're going to be going through that. And as Axel mentioned, every single dollar needs to get a return on it. A lot of those things are just seeing what else in the property is kind of, is not efficient, is leaking, is a safety hazard, LED lights. We have a lot of things are poorly insulated, and now there's a lot of incentives out there for insulation. A lot of low flow water fixtures are now out there that are able to be put in for very, very low cost or no costs. There's a lot of, if there's dead space in basements and in attics, we look to see if there's ways to build out storage areas in those areas, and we can then charge an additional $30 a month or $30 to $50 a month, depending on the area, if they wanted to have access to a storage area. There's every way to create square footage to be lucrative, to try to make it performing, right? So every single square foot in your home should be able to be their systems, utility, or a performing asset in addition to that, to the base rent that they'll be paying. Also laundry, right? We have coin op laundry, which we're now moving to card op laundry. And folks they all want laundry no matter what, and they're happy to pay for it when it's on the premises. Parking, if there's parking now, we usually do a base rent plus X amount per parking. But this is all part of our value add checklist that we're going to be going through as well when we do these capital expenditures on these units. So I'll go back to this refi exit here.
Yep. And everything that you just mentioned isn't in our, those are all gravy on top of what we've put into this model. So any ancillary income items like that are above and beyond what we're already talking about.
Awesome. Awesome. So here's our, and again, this is a conservative model. So our NOI on year 2 is almost $400,000. They assign a cap rate of about 6.5% to that. Might be better than that. We would love it to be better than that, but we're going to be conservative and say 6.5%, which gives it a rough value of about $6 million, which is not bad, right? We're all into this for about 4.8 million. And we are going to have it valued around 6 million, if not higher than that on year 2. Per door is about a 150, and we're going to get a refinance on that about 75% of this value. That's going to be 30-year amortized. Rough rate, we are hoping to get better than this, but we have it set at 4.3. And what that does, right, is it returns 4.5 million into the project. Now, another strategy that we might be using is we are looking at the possibility of selling one of the or a couple of these buildings if we determine that we can get a higher return by selling them off prior to us renovating and releasing them up. Some of them have a couple of higher, more capital intense projects that if we put them on the open market, we might be able to even get a higher return on this. So that will also return some cash into the partnership. There's our remaining debt at that time. So proceeds here with our capital balance, we're left with about 320,000 in the deal. And that still is what I told you before. The preferred return of 9% still runs on any cash that's left in the deal until paid off. And it is our goal, right, as the general partnership to make sure everybody gets their capital back timely so that we can stop that clock. Because we don't get paid until the 9% gets paid. So that's how we have it structured now. So right now, currently, we have a 50-50 equity structure where the partners and managers will be retaining 50%, and all the limited partners and our capital partners will be getting 50% as well. One thing we don't have in here, which I really want to touch on, and again, most of you on this webinar, well, I'd say most of you are familiar with multifamily, some of you are not. Axel and I have both been massively successful in cost segregation strategies. Cost segregation is taking the 27.5-year depreciation that people get on real estate, and it shortens it it takes an accountant and an engineer to go out to a property and literally lays out, nail fixtures, wood, sheathing, asphalt, roofing shingles, and it goes down to the very detailed granular level, and it accelerates that depreciation from 27.5 years, some of it to 5-year accelerated depreciation. Plus, there's still bonus depreciation of 100% that is still in play until possibly they change the IRS laws, which I know this one's not currently in play yet to be disbanded, but I wouldn't put it past people to disband of that in the future. So what that means is for you as an LP and for us, right, is for all owners in the company, and you are an owner, if you are an investor in this deal, everyone gets the benefit of that tax loss the year it goes into service. So that cost segregation may end up happening in 2022, possibly 2023. But what that means is roughly 20% of our all-in cost, which is really our building and CapEx cost. So if we're buying for 4.2 and land value, let's say is, I don't want to put out numbers in play, but in my projections, what that means is there's going to be roughly a $750,000 to $800,000 tax loss the first year this goes into service and is after it's rehabbed, after it's leased up. And that gets split out amongst the percentage of ownership that the LPs have and the GPs have and that sort of thing. And everyone gets to share in that tax, the paper tax loss on the year that it goes into service, which is actually a huge benefit to a lot of people that are looking for tax deductions because they get a paper loss while the asset's actually making money for them. This is why I love this business, right? This is ultimately one of the reasons why I'm in multifamily, why I love this. And I just wanted to highlight that, even though it's not shown in these projections or analyses or spreadsheets, that's another big benefit that a lot of people have. So I think I'm going to go, the last thing to go to is just these returns, right?
Yeah, dashboard's kind of the easiest way to go about it, Nick. I think if you head back to the
Okay.
dashboard, yeah, on the right.
All right. So for the returns section, here it is. We have a project returns. I'm going to go over the LP returns because that's what people care about anyway. So Axel and I call this one, this is like, a solid double, right? Not a home run deal. I don't like to even try to sell home run deals because it makes it not real. This is a very solid local in a market that we have both targeted as a path of progress. With rents that are very realistic because we both already have them in our portfolios right now. We're actively managing for ourselves and for other clients. This is what the IRR is that we're looking at right now, which is roughly about 18% on your money right now, with a cash on cash at about 16 and an equity multiple on your money of 1.93. As you've already mentioned, we're trying to be extra conservative in our figures. And we like to underpromise. We're actually aggressive, so we're aggressive in our expense projections. We're conservative in our rental projections. So I would rather even go lower. We're trying to come up with these numbers, and I would like you to expect a 15% IRR. And anything you get above that, hopefully we hit it out of the park, and your expectations are wildly exceeded. That would be my intent and my goal. But that's, I think, roughly the numbers that we've gone through. And I think we've already been through the equity. We've been through the capital stack. We've been through the capital expenditures. I just highlighted the rough highlights of the pros of the deal. The risks that we go through primarily, right? I mean, people who are in this game and know real estate, risks here is that the market could shift, right? And maybe our cap rate would not be able to be hit at the 6.5%. Now we think right now it's a little lower than that. We think it's at 6.25, but let's say it doesn't get refinanced until a 7%. Well, what happens there is we have money that's left at 7%. It's very high. Again, I'm overly conservative, but let's do that. So we go to the refi. What that means is now we have 487,000 left in the deal instead of the 387,000. This money still gets treated as with 9%, right? And we have to fund that money. But here's what I love about real estate is that even if the market starts to collapse, I always look at this number, right? I look at our net operating income. This number here is what I look at, because what this means is this number minus our debt service, right? In this case, this is with our bridge loan, but here's where it gets more accurate. Principal and interest, right? Cash flow available. Even if the market turns, this asset generates cash, right? Every single year, it generates this amount of cash for all of ownership. And that's typically why I love this business and why I specifically like multifamily. I also have a whole soapbox, which I'm not going to get into now, as to even if the market does start to turn, I personally, with my being a stats nerd, feel that multifamily as an asset class is not going to be touched, because as people start to even lose their homes, their single family homes, they all still need places to live. As they start losing their homes because of loan modifications that the government does not approve after pandemic levels. That's a whole other soapbox we don't have to get into on this one. Axel, I like to talk, so just shut me up and we can move on.
No, I don't have too much to add to that. I think that the high levels here, rinse and repeat business plan, something we've done a bunch. There's not a lot of execution risk. Risk adjusted returns wise, this is kind of a shorter timeline from start to finish. I think that if you're going to compare these returns to, larger deals that have a longer cycle to be completed, or development deals, I think that, when you start to look at this IRR and compare it to what else you could find with a similar IRR, this is a really straightforward deal in a market that we know like the back of our hands, surrounded by properties we already own and manage, right? So it's really rinse and repeat on that level, minimal execution risk. And outside of that too, in terms of quality of neighborhood, these are C-class deals in B- class, C-class properties in B- class neighborhoods. So this is, if you're buying multifamily in Manchester, this is quite literally the area, Upper West Side of Manchester, which is where most of these buildings are, where you want to be buying, right? So real estate obviously is starts with location. We check that box. Second thing is, what's the risk profile of the deal? Straightforward deal to get, pretty solid projected returns here comparatively to, what we have to do to get there. And it's conservative underwriting. We can deliver faster than this, most likely. Obviously we want to under promise here. And again, I think that this is just right in our wheelhouse, I think, is the big takeaway, right? So it's not like we're going into a market we don't know and working with people that we don't know. So
Definitely.
Those are the only things I would add to everything you mentioned. And then, I'll stop talking as well.
No, you're right. And because it is a smaller raise, that's the reason why we're not doing this as a full syndication. We're not putting out an offering memorandum. We're not doing a PPM. We're really only looking for people who probably already know us, already like us, trust us, understand that we can perform, understand who we are in the local market. And that said, there's also another ask, right? So we have, I don't know if you can see my dates candle pulled up here. Can you?
Yep, I can see
it. You can.
It.
So right now our target closing date is actually in just 2.5 weeks, which actually means we have to get funds in escrow by the 13th. So we're already we're doing pretty well. So we're looking to raise. Where are we again for the capital raise here?
On the left side, yeah, we're looking to raise 979 according to the model here. Again, we're over raising there. We've already got 700 slotted, give or take a couple of bucks. And then obviously we'll have capital in this deal. I mean, really the last chunk of equity we're looking to raise is about 200 to 250K. And that number is kind of in flux here, but again, yeah, I mean, it is a timely situation, but we're most of the way there in terms of the raise. And I think that, I guess getting firm commitments probably by late next week, 10/7, 10/8 with the acknowledgement that you'd be funding the following week is roughly the timeline we're working with here. So a bit shorter than normal, like you're saying, but this is something that, we're bringing out later because it took a while to get our debt figured out, took a while to get the closing timeline, squared away. So nothing that as it relates to the deal, but just some of the more logistical parts behind the scenes.
Absolutely. If for the meantime, for those of you listening today, if you want to, if you're interested, typically you've gotten this email or you've seen this link that was accompanied by links to the due diligence, links to the photos of the properties. We have all that. I'm going to put that into an email. And if you have any questions whatsoever about the deal, feel free to reach out to us. We don't have a joint email yet, Axel, but my email is info@aarealestategroup.com. You can reach out to me. My team gets that, myself, Matt, and Sarah, our operations person. Axel, what's an email for you they can reach out to?
It's funny because you're seeing aligned real estate partners over all of this, and I'm still transitioning onto my new email. But as of right now, the best one is Axel, AXEL, @Brickleaf Properties. So that's BRICKLEAF properties.com. And again, for those who are seeing this, on my list, I can get, any more information above and beyond what we've already talked about here and what I've already shared. But yeah, apologies for the confusion here and the difference in branding. By the time this deal is closed, Brickleaf Properties will be retired, but still swapping the email over. So as of right now, the Axel @Brickleaf email is the best one.
Sure. One more note too. It said we had a minimum investment on the credibility package of $200,000. I think at this point, I mean, we're open to taking $100,000 increments, possibly others on exception, but we do want to try to keep it at that number if possible, or at least in very even numbers to help us balance. This is going to be a small group. Right. I think we're probably going to have 5 or 6 people with us, which is why it's not a full syndication and there's not going to be all the OMs and PPMs and everything like that. So just let us know if you're interested. If you've been with us before, great. If not, this might be a good one for you to kind of follow along in the process and see how it works and understand real estate as an asset class, especially multifamily real estate is much, much better than the financial markets, as my whole profession changed with what I found. So that is all from me. So info@aarealestategroup.com or Axel@brickleafproperties.com, right?
That's correct.
Excellent. Okay. And that said, I don't know how to sign off on these things. Usually I say, I'll see you on the next episode, but there's no next episode. So we won't do that. Axel and I both have podcasts. Yeah. Make sure we check out both of our podcasts. The shutupanddoitrealestate.com. And Axel, go ahead, plug your podcast too. Why not?
Yeah, why not? The Multifamily Wealth Podcast on Spotify and iTunes.
There we go. Thanks, everybody. And let us know if you have any questions whatsoever. Just reach out. We'll be there to answer them.